Hello again and welcome. This is Robert Schein, Managing Director and Partner at Blanke, Schein Wealth Management. Thank you for joining us. Today is Thursday, March 8th of 2022, and markets are moving again. Let's discuss what's making that happen. Thanks for watching. So on the heels of an up day yesterday, we are down today. So the volatility continues. And actually, that's a lesson to be learned. In fact, if you watched the first quarter market outlook in our preview for 2022 web broadcast in January, one of my key themes was where we're going to see heightened volatility. Well, let's look at right now in March, not even 3 months into it, and let's see if that's actually played out. Right now, if we look at the 1% movement as measured by just the S&P 500, if we use that as a gauge, year to date, we've seen market volatility of 1% movement, higher or lower. Right now, we're at 6 times, just year to date in 2022. Compare that to last year, only 7 times. So just give it another day or so, and we'll definitely meet, and I'm sure later on we'll definitely beat the market volatility. So what's the playbook right now? How do we do this? Well, we have balanced, diversified portfolios here at Blanke Schein Wealth Management for our clients that have seen, geopolitical headlines like we've seen, weathered some storms. We're positioned for inflation. In fact, this morning on CNBC and Forbes and a few others, Fortune magazine, I was quoted as to the most recent 40-year high in inflation that we saw this morning. And ultimately, the quote was that we have not seen the peak inflation. In fact, if you look at February's read this morning, which is 7.9%, and that matched inline expectations, that does not take into account the most recent week and a half spike in oil prices. So we all see the pain at the pumps and the gas prices are spiking. So it's inflationary, and it's more than just transitory. It's going to be more sticky. It's going to put pressure on the Federal Reserve next week. But the good news is that next week is the much anticipated Federal Reserve meeting, right? They have a 2-day meeting concluding on the 15th, and we should get the sort of the final judgment, the announcement. There's been so much speculation from January 5th all the way now as to what the Fed's going to do. Next week, we're going to find out what they're actually going to do, and they're going to give us more sort of picture preview. We believe it's going to be a 25 basis points, and then it's going to be hey, let's continue to moderate as we go higher in terms of interest rate hikes, but do a sort of a wait and see type mentality. But they have to acknowledge that they have missed the mark and they're behind the curve as it relates to raising interest rates. Because as oil prices stay persistently high, again, one of my quotes in one of the publications this morning, it doesn't always continue to tilt an economy into recession when oil prices are above 100, but it continues to put pressure on the consumer. The pressure on the consumer will ultimately obviously could hit to recessionary sort of a opportunity for 2023. So we hope not, and the Fed sort of has to balance between the two right now and see how it navigates through this. And we also have the geopolitical turmoil is also sort of a decoupling of what we're seeing from an investment perspective. Obviously, you're not only seeing all of the NATO, UK, EU, obviously the US and many other nations pull away from their investments or even just their relationships with Russia. So there's a decoupling of sorts. Obviously, Russia's the bad actor right now, and markets are pulling away, corporate America's pulling away, capital markets are shutting down. Now, what does that mean? Well, when capital markets shut down, and specifically there, flows have to come somewhere. And if you think about it, we are raising interest rates here in the United States because we have a tight labor market and a very strong economy right now, and corporations can and still are making money. Profits are rising, okay? Our GDP is growing, not as much as last year, but comparatively, we are higher growth rate than normal. So all of that is a backdrop to when the decoupling of the global economy happens and there's a disruption of money flow, watch the capital flows. Capital flows are flowing in from EU, from obviously sort of places in Russia and to the US markets. And we're also we're seeing capital flows come in from Canada as well if you watch the daily capital flow report. And that's very important because you happen to say, hey, wait a minute, what's the next stimulus here since the Congress is not going to provide it, or the Federal Reserve is actually removing stimulus or liquidity from the overall backdrop? Well, one might say and submit for consideration, which we believe if you watch the capital flows that are coming from the decoupling globalization right now that we're seeing, they're going to have to find somewhere. And you know what? The United States is the best place right now because we're, again, a growing economy. We're also a safe relative to what the other options are. So we could see more than likely the U.S. reinvestment from those dollars that are flowing in. As supported by a strong dollar that we're seeing right now, and even Canadian dollar is weakening, and that's sort of a signal that it shouldn't, because Canada is a petrodollar, right? Their economy is by oil, and if oil is sort of strong right now, which it is, it's spiking, their economy should be having a strong dollar, if you will, in Canadian. Over in Canada, but they're not. So that means that the flows are coming in the United States. So that's interesting to watch. We're watching the capital flows. That could be another stimulus and support here as we see market valuations bring us plenty of opportunity. So stay tuned right now, because we're going to go to our special guest, Don Stockhausen. Thanks for watching. So I'm excited to announce that we have right next to me a celebrity guest here, Don Stockhausen. He's our advisor, our all-star advisor in Wisconsin, and he's out here in Palm Desert, California right now, obviously for the 70-degree blue skies, Chamber of Commerce weather that we're having right now. And anytime that Don's in the office, it just lights up everywhere he goes, and everyone's super excited to have him with us today. And so, Don, welcome. Thank you for coming in.
Robert?
Well, let me do this real quick. I'm going to ask you a question. Words of wisdom for Don. While we're here, this is a message to our clients, sort of words of wisdom. You've seen this before, maybe not. Today, we just got a negative print on the CPI report, right? So 7.9% on inflation. It's a 40-year high. We have pain at the pump. You see this here at California. I don't know what it's like in Wisconsin, but everywhere we're going, we're all feeling it as consumers. We're seeing the geopolitical headlines extremely negative. I don't think there's any positivity out there, Don. What would you say to our clients, to our investors? And if you've seen this before, what's the words of wisdom?
Having been at this game sincerely since I was a teenager and a failure as a baseball pitcher, I would say long-term in the stock market today happens to be about 2 hours, okay? So if you look at yesterday and the reversal, and then I looked at today and it was down, the Dow was down 400 and something, chances are it'll be up or even by the end of the day. Therefore, you have to ignore a lot of stuff and fish for the best fish, okay? So what I look at and try to employ, and my clients have the same stocks as I own, okay? We're seeking dividends and dividend growth and cash flow. Now, many of these stocks are down 10, 20, even 30% since the end of January. Therefore, this provides an opportunity. And sometimes we may only buy with the dividends and interest that we get and not put additional cash to work. But looking out 6 or 12 months, I think this is a terrific opportunity for our clients.
So what I hear you saying is, ignore the headlines, stick to the fundamentals and your discipline, which we clearly have that approach for our clients. Headlines will be headlines. And if it's something today, it's also going to be something tomorrow, but have a process and a discipline. And also I hear you, reinvesting, right? So using the power of compounding. And before you know it, we look up and we have share accumulation. We own the right kinds of companies, strong balance sheets, cash flow, paying some dividends. Clients kind of like that. Mm-hmm. That's great advice. Well, Don, thank you for joining us today. And let's go out there and have some fun. Maybe get golf or tennis in while you're here, too.
Okay, let's do it.
All right. Thanks, Don.
All right, thanks, Rob.
Bye.